Interest rate cuts are coming, markets know it, media is talking about it, investors are waiting for it. Normally, this would be bullish. But look closely. Markets are not celebrating. They're cautious, they're hesitant, they're almost suspicious. In this video, I want to explain why rate cuts are coming, but markets are not reacting the way most people are expecting it to, and why misunderstanding this can cause the investors badly. So most investors hear the words rate cut and they think one thing: relief, rally, risk on. So that reaction is conditioned, but markets are sending a different signal. If the rate cuts were clearly positive, prices would already be moving much higher with confidence. Instead, markets are drifting. That tells us something important. The reason behind the rate cuts matter more than the cuts themselves. Central banks cut the rates only for two reasons. First, growth is strong, inflation is under control, and policy is normalizing. These rate cuts are bullish. Secondly, growth is slowing, demand is weakening, and support is needed. These rate cuts are defensive. Right now, markets believe rate cuts are coming because momentum is fading, not because growth is accelerating. That single distinction changes everything. Defensive rate cuts reduce the pressure. They don't create optimism. They tell the markets that something needs support, risk still exists, and visibility is limited. That is why markets hesitate. Rate cuts stop things from getting worse. They don't automatically make things better. So instead of buying aggressively, investors have to wait for the confirmation. Another subtle but critical shift is happening. Earlier, good news created optimism. Now, good news only creates relief. Relief rallies are weak. They fade quickly because they don't change long term earnings or growth trajectories. Markets are waiting for signs of reacceleration, not just support. Until that shows up, rate cuts remain a cushion, not a catalyst. So, rate cuts are not a signal to rush. They are a signal to slow down and observe the context properly. You should ask, is growth stabilizing or accelerating? Are the earnings improving meaningfully? Is risk appetite broadening beyond a few stocks? If those answers improve, rate cuts turn to be bullish. Until then, caution is rational, not pessimistic. If you want market explanations that focus on why things are happening, not just what is happening, subscribe to this channel, because in markets, understanding the reason always beats reacting to the headlines. Thank you.